That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Or look at it say, it's beautiful!
Welcome to the fucking show.
Welcome to the fucking show. All right, ladies and gents, we are live. We are talking about Dutch Bros earnings today, so it'd be interesting to see and go through to see what is up with the stock. Thank you for the already 10 of you joining me on YouTube and several others that have clicked on X. Fun to see the stock is already showing up well after hours, but yeah, originally it looked like it was about to dip, but now here we are. It looks like things are turning out pretty well. So let's hop into the actual news, specifically about what is going on for Q3. And with that, then we can hop into the presentation. There's some more in-depth material in there, of course, and so we can take that opportunity to do that. All right. So Q3 2025, specifically 2025 achieves 25% year-over-year growth in revenue, delivers 5.7% same system sales growth, which is good, and 4.7% transaction growth. So almost 5% more transactions, and then almost an additional 1% on top of that is additional ticket sales. Delivers 7.4 company operated same store sales growth. That's insane. And then 6.8%. So the company operated stores are showing up better than the franchise stores. Interesting. That's pretty insane. Actually, let's go to this one. That's really insane. Was not expecting that. One of the fastest growing brands in the U.S., quick service beverage industry today, reported financial results as of the end of September 30th, 2025. Christine Barone, CEO and president, stated Dutch Bros continues to exceed expectations driven by passion. Our broistas bring to our shops every single day a focused set of transaction driving initiatives that provide multi-year growth visibility and the strength of our new shop openings and pipeline. Let me just make sure that I'm sharing and everything and the like. Okay, good. We're on track. Brown also continued our third quarter results reaffirm our strength of our differentiated strategy and exciting road ahead. We delivered revenue growth of 25%, same store sales growth of 55.7%, and company operated store sales growth of 7.4%. Huge. Third quarter marks our fifth consecutive quarter of positive transaction growth, elevating Dutch Bros to a category of its own. New shop productivity remains elevated. System AUVs are at record highs, and the strong system same shop sales performance through October continues to build the confidence that they've had to 2,029 shops by 2029. Based on the results and the strength has continued through October, we're raising our full year guidance for total revenues and same store sales growth, reflecting the confidence we have in the long-term durability of our model and effectiveness of transaction initiatives. And I already went through the presentation a little bit behind the scenes, so it looks good. So far looks good. We'll hopefully maybe see it in this highlight. So if not, we'll get into it during the presentation. So we opened up 38 new shops this quarter, 34 of which were company operated across 17 different states. Revenue grew to $423.6 million as compared to $338 million in the same period of 2024. System-wide same sales growth increased 5.7%, and system-wide same shop transactions grew 4.7% relative to the same period in 2024. And the company-operated same shop growth increased 7.4%, while transactions in company-operated grew 6.8% compared to the prior year quarter. Company-operated shop revenues grew 27% to $392.8 million compared to $308 million in the prior year quarter. And then company operated profit was $82 million as compared to $68 million in the same year prior quarter. Let's see. In the third quarter, company operated shop margin which includes 180 basis points of pre-opening costs, was 21% a year ago, decrease of 120 basis points. So profitability went down slightly. Wonder if they'll detail that in the call. And then company operated shop contribution grew 20.2% to 109.2, as compared to 90.8 in the same period 2024. We already read that. So SG&A is 15.4% of revenue, is 65 compared to 57. So that continues to trend in the right direction of only being 17% of revenue. So that's good. Year-over-year decrease of almost 2%, but 1.6% overall. And then adjusted SG&A was only 13.6 versus 14.9. So pretty good. Net income was 27 compared to 21 million. EBITDA grew to 78 compared to 63. Keep in mind, there's a lot of DD&A depreciation costs associated with this because of the real estate. So EBITDA is a more reflective measure of cash performance of the company than net income because of their real estate presence. Net income per share was 14 cents compared to 11 cents in the prior year quarter. So up pretty significant in that point. And then 19 cents for fully diluted common stock versus 16 cents. So the 2025 guidance is now growing to 1.61 and 1.615 billion. And they're expecting same source sales growth to be 5%. EBITDA being 285 and 290, which assumes 110 basis point adjustment to SG&A. And then CapEx in the range of 240 to 260 million. So cash flow positive, right? And then the total stores to be 160 with a back-weighted pipeline in Q4. Any new shops openings below 160 are planned to be incremental to the 2026 target, reflecting confidence in the shop growth trajectory. 2026, they're targeting 175 stores. Wow. That is that's pretty insane. I can't complain with that one. That looks pretty bien. Pretty bien if anybody's following and actually caring. How's the stock look? The stock is sticking at $57. So we're good on that front. So let's look into the actual presentation. So shop sales or shop totals grew 14%, 130 shops year over year. Excuse me. So from 950 to 1,081. So 114 company operated stores, and the rest was 305 to 322. So about 17 stores franchised. Total revenue up 85 million or 25% from 338 to 424. And specifically company operated went from 308 to 393, which is at 85 million. So franchise almost was flat. Contribution margin, which I think is why the company might not be running right now, because although revenue did well, company operating margin and contribution margin actually went down from 29.5 in the prior year quarter to 27.8. So not bueno. 160 basis point hit impact there, looks like. But net income as a whole went up 22%. Adjusted EBITDA went up 22%. From 64 million to 78 million. So we continue to see strong performance in total transactions, like I stated. They saw 1% higher ticket price, 4.7% higher transaction system-wide, and then company operated. They saw 6.8 higher transactions with a slight increase in ticket volume on average by about 0.6, which is pretty good. Pretty damn good if I don't say so myself. I mean, you're seeing continued ticket sales growth. That means the stickiness of whatever people are buying is there, even though you're raising prices, and or they're buying more, which I think is going to be influential and I'm sure they're going to discuss a lot about food today, their new food rollout. And so I'm sure that impacting ticket sales prices. Will they be between 0.5% and 1% for company operated shops? I think somebody's going to raise a stink about that. Let's see what caused the increase in overall expenses to cause company operated shop contributions to go down. So looks like labor costs went up pretty extensively, but doesn't look like it's the big showstopper. Interesting float. Yeah, I'm surprised that ops margins didn't perform as expected. Um, Outlook, yep, we just went through this. 160 stores, revenue 1.61 to 1.615. Same shop sales growth of 5%. Now, this is one of the more important slides that I like to look at because I like to look at this SG&A portion and see what it is in terms of percentage of total revenue. So obviously, 2 years ago we were kind of in the high to mid 20s, and we've slowly been able to decrease that over time. But yeah, you can see this depreciation cost continues to go up and to the right as they continue to have more and more of excuse me, real estate. Oh, this is specifically for SG&A. Okay, maybe that's not as important then on the depreciation cost for that. I was gonna say this seems pretty small. It's like less than $1 million. So here you go, adjusted EBITDA of 78 billion. So net income of 27.3 billion. So that's not horrible. That's not absolutely horrible. So you're looking at adjusted EBITDA margin of 18%, which is a slight slowdown compared to where we were. But last year, prior quarter was 18.9 compared to 18.4 this time around. And it was 20 the year before. So what key things did we have that really hurt? And really it just looks like employee costs and equity compensation, but nothing that should be too horrible. So I think it might just be interest in other items. Net income reconciliation. So equity compensation isn't an actual cash charge; it's a non-cash charge because they make the shares up and they give them to employees. But you have employee-related costs, income tax impacts, etc. So you can see we went from 27.6 million in net income adjusted last year to 33.5. So an increase. Decent increase. Stock continues to hang on there pretty strong, 57.35. You can see I started initiating my small buys again. So I'm up like $15 or so on the whole buys, but I have more in my individual brokerage account, not in my Fidelity, not necessarily in my Robinhood. All right, so let's run through, see who and everyone is here. Late like a mitt. Jetlag is also having a beer celebrating another successful rocket launch. I wish. What's going on, Dead League? Hot Adam. Yep, 19 versus 16 cents. Wanted to hear about a mitt. Yeah, that rather yak about trash stock like Alpha and Duolingo. Still a bit flat. Breaking Matt Money has been arrested for impersonating a human. He's a goat. Heard it here first. When Moon, good question. Let's go get Dutch Brothers today. Best coffee. Can't in the country I'm in today, unfortunately. Love the stores, the products, logo, colors, execution. Need a coffee? Bros has some. Yet to have a bad customer service experience. Agreed. I'll need to try the Dreamweaver when when I have a day where I'm like deciding not to eat much. I don't know if I've ever had the Dreamweaver. I've had the Golden Eagle, but believe it or not, before I left, this was like mid last week. I was like, I need something pumpkin related. Haven't had anything pumpkin related yet. And I went and I was like looking at the menu and I was like, I will not have anything pumpkin related. Your boy's trying to keep a little thinner. I do need a Dutch Bros. Your boy is sleepy. That lag got me. VG's going to 0, man. I thought you knew. I don't have a price target for next year. Sorry, that's not how I operate. When is it operating or expanding to Europe? I'd say they probably won't expand until the early 2030s at earliest, in my opinion. I think right now they just have so much opportunity ahead of them, and they can guarantee approximately 2 million annualized unit volume per store that they open up on the East Coast. And I just don't think it makes sense for them to. Just don't think it makes sense for them to try to go to Europe and expand to Europe right now. Plus, you'd have to find a roaster. I just don't think it'd be advantageous for them right now with the opportunity set in front of them in the United States. But I know people are probably wondering selfishly, right? Because obviously that means they'd be able to get it, and I think a lot of people in Europe would really enjoy Dutch Bros. I really do think they would. Yeah, they can do a lot of expansion. A lot of expansion. I think that they're just getting into South Carolina, or maybe it was North Carolina. They're just getting into Georgia, Indiana. They're just getting into. So they still have Ohio, all of the Northeast. They're in Florida at this point, so it's just a matter of time before they get into the Carolinas, Virginia. Yeah, in Texas, every time I drive by one, there's generally a line. So I don't know. I don't know. And so people are probably sitting here like, is it expensive? Is like, and the stock's worth 9 billion, right? Um, so they stated we're going to be we're just call it 285. So we'll take 9,100 divided by the 285. So we're only at a 32 price to EBITDA, you know? So it's not horrible. And if you're growing at 20%, and that's what's going to be for fiscal year 2025. Let's just say, for example, for the next 2 years, you grow at 20% a year. So you're at 285 times 1.2 times 1.2. That's a 400 or so million dollar EBITDA. And so then you're trading at a price to EBITDA of 22. And this is, to me, is a premium company, right? Like, it's not a company that should trade at like a 15 multiple or something like that. So I think a fiscal like, I think that this is actually, like, I don't want to say dirt cheap. It's not dirt cheap, but for the growth that it's at, coupled with if food goes well, now food could also impact contribution margin. So that's something when food gets raised, that's something I'm really paying attention to because, initially when food gets rolled out, I'm sure it's going to be slow. There's going to be process that needs to be kind of associated with, adding that in, but they're not going to be creating food from scratch. You know what I mean? Like, we're not talking McDonald's level here. I think that's all going to be kind of pre-made sort of stuff. So the hope is, I think, that they can attract someone else. So I think they want to be able to figure out a way to attract somebody either once a day, which at a minimum once a day, which they might go every other day or every third day to go to Dutch Bros to get their pick me up. But if they also have a food item, they'd be more likely to go. So I'm curious. Yeah, I'm very curious to see because their margins from drinks are so good. So I'm not entirely sure if they're trying to make the food a loss leader or something like that. It doesn't seem like it because the food's not exactly dirt cheap. But um, but yeah, but yeah, overall, it seems to be in a pretty decent spot for that. North Carolina, I thought just in the US. And the thing that's nice about going east compared to going west and expanding on the west coast is the east coast, generally speaking, has much lower hourly rates. And so the hourly rates that really put a drag is when you're talking about expanding more so on the west coast. So let's see if there's anything on Dutch Bros earnings on like CNBC or anything like that. Dutch Bros news release. We got me streaming. We got Christine Baroni. Let's see if there's anything. Okay, nothing yet. I was hoping to see something on like CNBC or something like that, and I don't see anything as of yet. But so far, it's looking pretty healthy. We've got 15 minutes before the call actually starts, so I'm very curious if anybody has any thoughts that they want to touch on ahead. So let's see. Was there any updates, particularly around the Bros? Doesn't look like it yet. What does this have to say? Listen.
Week or so in the markets is whether we've hit an inflection point over how AI spending and valuations will be scrutinized going forward. Mackenzie Sigalos joins us now with more. Hey, Mac.
Hey, Scott. So names like Oracle, Broadcom, AMD, and NVIDIA have all surged in the past few months off the back of OpenAI partnerships. But now the focus is on who is turning those headlines into real revenue. Only AMD is reported so far. And while it did beat on earnings and guidance, the AI upside is still missing, with the Q4 guide coming in light of the whisper number, despite AMD handing over 10% equity to OpenAI virtually for free in order to land their business. And that brings us to the hyperscalers, where we're seeing two very different categories of AI winners. So Amazon and Alphabet, they were both rewarded for their AI infrastructure spend. Shares in the two companies hit record highs after showing strong cloud growth, boosted by their own custom chips, helping to offset that NVIDIA tax. Now, Google also has the added upside of Gemini, its in-house model that's reportedly set to power a revamped Siri in a deal with Apple worth $1 billion a year. Now, Microsoft and Meta, on the other hand, they have sold off since reporting. Microsoft lost right of first refusal on OpenAI's compute deals, and Meta, it reported a soft Q4 guide, and it's spending like a hyperscaler without a cloud business to justify the outlay. Scott?
All right. So there is that. Let me just check in on CNBC. Once again, guys, sorry, this isn't my normal setup, so appreciate that I'm streaming from a different place and internet might not be as quality as used to. Not that my internet's ever great. It's just there. But ooh, let's see. We got two additional. I know Amit is currently on the scene. talking about these ones, but while we're waiting for the next 12 minutes, let's just do some quick look at some of these things that have come out with earnings reports.
Morgan. So Robinhood shares falling a little over 2% in after-hours trading, despite being on the top and bottom line. The company posted earnings of 61 cents a share, above the 53 cents that analysts expected, and revenue of 1.27 billion versus the 1.19 billion estimate. Transaction-based revenue, that was a little bit light at 730 million, despite record trading volume in equities and options. But that shortfall was offset by strong gains in net interest income. Now, funded accounts, also a slight miss at 26.8 million. Meantime, a C-suite shakeup. New CFO Shiv Verma is taking over for Jason Warnick. I spoke to them both moments ago. They pointed to prediction markets as a major bright spot, calling it their fastest growing business ever. Contract volume doubled Q3 versus the second quarter. And in October alone, they saw more trading than the entire prior quarter. They say that momentum is strong heading into Q4 with record customer deposits and activity. Those shares, though, more than 4.5% lower now.
Company beating on earnings, but revenue of 340. Health earnings are out as well, and the beauty company beating on earnings, but revenue of $344 million was 22 million short of the estimate, so you can see a big drop there too. Shares are currently down 16%. Its guidance for earnings and revenue both well short of the current consensus. The company noting that gross margins decreased 165 basis points, and that was driven by higher tariff costs.
Hey, Snap shares soaring. The stock now is up about 15% in after-hours trading as the company's revenue beat expectations, 1.51 billion versus the 1.49 billion estimated, with 1 million more daily active users than anticipated. The company's earnings per share loss of 6 cents isn't comparable to expectations, but adjusted EBITDA of 182 million did top estimates of 125 million. Snap announcing a $500 million stock repurchase program and also guiding to fourth quarter revenue in a range with a midpoint just ahead of analyst expectations, also guiding to Q4 EBITDA in a range well ahead of the consensus estimates. Snap also announcing a with Perplexity to bring its AI chatbot into Snapchat. Perplexity is paying Snap $400 million over the course of the year. Snap did warn, though, that they expect daily active users to decline in the fourth quarter, as they also said that their investments in AI and machine learning are delivering measurable gains for advertisers. Shares now about 14.5%. Back.
That's insane. Expected MAU down
more than 12%. It's not because of the headline numbers here. It's not because of the top line revenue. Revenue did beat at 3.45 billion versus 3.36 expected. EPS missed 55 cents versus 69 cents expected. And there's a wrinkle here in what DoorDash is leading investors to think about going forward. First, to give you a couple more numbers, total orders were up 21% year on year to 776 million versus 770 million expected. So the core business looking solid. Marketplace GOV up 25% year on year, also a little bit better than expected, but two near-term hits to profitability to look out for. DoorDash warning in the release here, robotics, software, and a common platform across DoorDash, Deliveroo, and Volt. They're going to be investing in that. They say, quote, we currently expect to invest several $100 million more in new initiatives and platform development in 2026 than we did in 2025. Also, they're going to invest a bit more in Deliveroo, that acquisition. They expect it to contribute approximately $45 million to adjusted EBITDA in Q4 2025 and about $200 million to adjusted EBITDA in 2026. What they're saying, actually, it was growing a little bit faster than expected, so they expect to invest a little bit more. And because, perhaps, of that shift, they haven't given all the detail on profitability. The stock down about 12% right now.
All right. Well, I have. A call hanging out in the background. I'm not entirely certain if this music is copyrighted or not, so we will wait until the earnings call actually starts. But I'm curious, are people picking up Dutch Bros? I've seen some people with some renewed interest now that the stock is kind of retraced from its highs almost over a year ago. For people that have been following, The stock was at once $85. It popped up to $85 ahead of the 1Q earnings. And after 1Q earnings, it still did really well. So not 1Q, full year earnings for 2024. It still did well. Things are going the right direction. I think it's just it moved up too quick, I think, for people. But it seems like that's relatively the case. It seems like it's always a sell the news event after the earnings report. It looks like it's always generally received rather well, but then a few days or a few weeks after, it just continues to drift. So we'll see. We will have to see. What happened? Did they stop playing the music, or did? Let's see. Nope. Okay. Might have just been me lagging for a sec. But yeah, I agree. Anything under 60 is good money. Is good money for the stock. What other things are people buying, if anything? I know it's tough. We're not exactly out of the woods when it comes to cheap shares these days. You know, so it's kind of tough to be able to buy. But you got some good opportunities. 30,000, $30,000 or 30,000 shares. So no, Adam's got that money. I don't think Adam actually does like any true due diligence. I think he just buys what he thinks sounds fancy. He went hard on Rocket Lab and then he sold it and then went into SoFi. I don't even know if he's still in SoFi, if he sold that, but he's doing well with it. Doing better than me. Doing much better than me. Here we are on Fire Day. So if you guys hear any fireworks or anything in the background, that's what that is. And now he's back in Rocket Lab after selling out too early. That's one thing I want to keep warning people is like, I think a lot of people are like, ooh, but if I sell and it goes down 5% and I buy back in, and it's like that might work in a tax advantaged account, but when it comes to, let's just say you bought it $5 and it went to $55, right? Your capital gains, especially if in the short term, are going to be $50 a share. You're going to have to pay, let's just say 30% on that. So $15 a share pretty much is what you're going to have to pay. Sorry, that's not true. 20%. I'm not smart with math. You guys know that. So let's just say it's 50. So yeah, you're gonna have to pay 10 cents $10 a share. Um, so let's say it's trading at $55. You're gonna have stock drop to at least 45 before you even break even. You have to pay all those. So you got to really think like, can you actually time some of these things as well as you think you can? And I would beg to say that most people cannot. So, all right, 3 minutes. Never been to a furry convention. Oh, you heard it here first. Um, but yeah, excited that we're gonna hear. I'm very curious to see what they're gonna be talking about when it comes to the food portion of Dutch Bros, the expanded 6Q menu, retiring some which is kind of a shame because if you've ever had the muffin tops from Dutch Bros, they're actually quite tasty. So fingers crossed that the new menu items do well. And they've already gotten the branding around and showing people. I was there before I left for this work trip over to the UK, and they had signs up saying, "Hey, we have new food coming," and a bunch of other things. They had their seasonal drink menu out. for the pumpkin spice stuff, and not spice, but pumpkin flavored stuff. Which I'm sure they have pumpkin spice stuff as well. But yeah, we got some really good classic music going on over here in the earnings call, but stock's staying flat based off the news. Maybe up like 1 or 2%, not even. No, I guess 4% after hours. That's pretty good. I don't know why this mouse keeps freaking out, but 4% after hours is not bad. I would love to see some additional sugar-free as well, but they do actually in some locations have sugar-free pumpkin. So if you want to get like a pumpkin flavored something or other, you might be able to get something that's pumpkin spice. Trailer needs a new propane heater. There you go. Someone's got to do it. All right, we should be within a few moments of this call starting. So appreciate you guys' patience as I kind of filibust my way through this. It'd be nice, man. We'll get this call done. It's 10 p.m. here, my time right now. Yeah, the energy drinks are quite tasty, especially the zero sugar ones. You know, they do a pretty decent job. Yeah, they do a pretty decent job. All right, so here we are, 5 p.m. Eastern. All right, here we go.
For standing by, and welcome to the Dutch Bros third quarter 2025 earnings conference call and webcast. This conference call and webcast is being recorded today, November 5th, 2025 at 5 p.m. Eastern Time, and will be available for replay shortly after it has concluded. Following the company's presentation, we will open up the line for questions, and instructions to will be provided at that time. I would now like to turn the call over to Neil Patel, Dutch Bros Senior Manager, Investor Relations. Please go ahead.
Good afternoon and welcome. I'm joined by Christine Barone, CEO and President, and Josh Gunzer, CFO. We issued our earnings press release for the quarter ended September 30th, 2025, after the market closed today. The earnings press release, along with a supplemental information deck, have been posted to our investor relations website at investors.dutchbros.com. Please be aware that all statements in our prepared remarks and in response to your questions, other than those of historical fact, are forward-looking statements and are subject to risks, uncertainties, and assumptions that may cause actual results to differ materially. They are qualified by the cautionary statements in our earnings press release and the risk factors in our latest SEC filings, including our most recent annual report on Form 10-K and quarterly report on Form 10-Q. We assume no obligation to update any forward-looking statements. We will also reference non-GAAP financial measures on today's call. As a reminder, non-GAAP measures are neither substitutes for nor superior to measures that are prepared under GAAP. Please review the reconciliation of non-GAAP measures to comparable GAAP results in our earnings press release. Before I pass it off, I'd like to take a moment to acknowledge Patty Warren.
Strategy, one that continues to fuel our momentum
and unlock meaningful
That was weird. Sorry
long-term
about
value
that.
creation.
Hopefully it wasn't like that for long.
The road ahead is both exciting and full of opportunity, and we are just getting started. In Q3, we delivered revenue growth of 25%, system same-shop sales growth of 5.7%, and company-operated same-shop sales growth of 7.4%, reflecting the strength of our strategic focus and continued customer demand. Our transaction-driving initiatives continue to demonstrate outstanding results, with growth across all day parts. System transaction growth was 4.7%, and company-operated transaction growth was 6.8% in the quarter. Q3 marked our fifth consecutive quarter of transaction growth, making us a clear outlier in the current environment and putting Dutch Bros in a category of its own. This performance underscores our ability to drive durable growth through a focused set of idiosyncratic transaction drivers. New shop productivity remains elevated, with system-wide AUVs at record highs. We continue to see consistently long lines and strong customer demand as we expand into the Midwest and Southeast. These results underscore the broad appeal and portability of our brand across diverse geographies. Our long-term system shop opening cadence remains firmly on track, and we remain highly confident in our goal of 2,029 shops in 2029. We've successfully expanded into 6 contiguous new states this year, including 5 in the third quarter, bringing our total presence to 24 states. I'm very excited to share that our shop opening cadence is expected to accelerate heading into next year, with approximately 175 new system shops projected to open in 2026. We continue to step forward in our growth journey, reflecting the strength of our pipeline, our confidence in our four-wall model, our continued performance of shops in new markets, and an annual growth rate consistent with our mid-teens new shop target. We've also made continued investments in people, tools, and processes, and market planning over the last 24 months. These investments enhance our ability to execute with discipline and transition us to a place of accelerating our pipeline. Our pipeline, which has now reached record levels, has approved shops at a pace of 30-plus potential sites per month over the last 6 months, as the investments in our real estate team and strong AUVs continue to reinforce our confidence in reaching our goal of 2,029 shops in 2029. Momentum is continuing to build, and I've never been more confident in our ability to execute on our ambitious growth plans. Our Q3 results set a strong tone for the year, and the strength has continued through October. We are raising our full-year guidance for total revenues and same-shop sales growth, reflecting the confidence in the long-term durability of our model and the effectiveness of our transaction-driving initiatives. Josh will share more details shortly. Let's begin today's business update by talking about what differentiates our brand. Our culture and our Broistas are the heartbeat of our brand. It's something that simply cannot be replicated. It is not just what we do, but how we do it that sets us apart. From the moment the customer pulls into our drive-thru, they experience energy, authenticity, and a genuine sense of belonging. We are in the business of making people feel seen, heard, and appreciated. Our Broistas create a high-energy, welcoming environment that turns a stop at a drive-thru into a memorable moment. Our service model is built around authentic interactions and fostering real relationships. This deep emotional connection keeps our customers coming back day after day. We have a simple but very powerful mission. It is to be a fun-loving, mind-blowing company that makes a massive difference one cup at a time. During every interaction, our Broistas have an opportunity to brighten someone's day by living our core values of radiate kindness, get up early, stay up late, and change the world. Our drive-through model is purpose-built to deliver an exceptional experience that balances the interplay of speed, quality, and service. This one-of-a-kind approach allows us to serve high-quality, handcrafted, customized beverages with remarkable efficiency and consistency without compromising on our customer experience. Since 1992, we've been hand-pulling espresso shots, crafting beverages, and serving love with precision and care. Our ability to offer extensive customization is unmatched, empowering customers to create drinks that are uniquely theirs, turning every drive-through interaction into a moment of powerful emotional connection. This level of customization, paired with our high-energy service model, continues to resonate with our customers. It is about the connection, the excitement, and the consistency of our experience that keeps the Dutch Bros customer emotional connection so powerful. And our customization-forward approach is improving with our focus on throughput. The sequential transaction growth we saw in Q3 showed clear progress on this initiative as we begin translating our efforts into results. Our training programs for shop leadership are driving smarter labor deployment decisions across production zones and day parts, improving quality and elevating the customer experience through consistency. We are beginning to see a shift in peak demand patterns driven by our transaction-driving initiatives. With improved labor deployment, we are now better positioned to meet this evolving demand. Enhanced shop dashboards are empowering shop leaders to make better deployment decisions during peak and off-peak hours. And as a result, we're gaining better traction across order taking, order making, and order handoff, all while delivering industry-leading customer service. Let me take a moment to highlight how we ensure a consistent customer experience. Before Broistas ever make any beverage, they're immersed in our purpose. They learn what makes Dutch Bros so unique. It's the connection, service, and energy. Only then do they begin our training, mastering not only the beverage making process, but learning every role in the shop. We've built a shop environment that is electric, fun, and unmistakably Dutch. It's this energetic environment that fuels a positive Broista experience, which in turn drives a consistent, differentiated experience for every customer. Our company-operated model provides a clear path for growth, whether it's through the operator pathway or becoming a leader for our mob training teams. Today, we have over 475 operators in the pipeline, with an average tenure of approximately 7.5 years. It's this clear pathway that allows us to build depth and experience and to scale our culture effectively. And it's working. In the 2025 InTouch Insights QSR drive-through report, we ranked #1 in order accuracy, satisfaction, and beverage quality across beverage players. Dutch Bros also earned the top spot in Forbes' 2026 Best Customer Service list in the beverage category within restaurants. That is the power of investing in our people and the Dutch Bros difference. We're thoughtfully expanding our beverage-first concept through our food program, which has evolved from a pilot into a broader rollout as we close out 2025 and head into 2026. Our food program rollout is designed to strengthen our beverage offering by driving breakfast and morning part occasions, a time of the day where we have tremendous opportunity. As we expand the food program throughout 2026, we're aiming to be a one-stop shop during the morning day part. We continue to see both ticket and transaction lift from our food program, which expanded to approximately 160 shops by the end of Q3. We are regularly measuring customer feedback KPIs such as quality, likelihood to recommend, and value, and we are very pleased with the results, which have remained consistent or improved with each successive phase of the rollout. Looking forward, our 2026 rollout cadence will follow a strategic and methodical approach, with plans to complete the rollout by the end of the year. Due to shop layout constraints, we expect that approximately 25% of our 2025 year-end shop count may not be able to accommodate hot food. However, that percentage will decline over time as our new shops are being built to accommodate hot food. Our strategic push into breakfast and the morning day part through our focused food rollout only strengthens the Dutch Bros model, making it even more compelling. We have built a strong and differentiated digital presence, powered by our initiatives that are continuing to translate to transaction strength. Our enhanced paid advertising strategy to build brand awareness continues to deliver impressive results across our shop base, especially in our newer markets and vintages. These efforts are fueling our transaction momentum, and we expect this trend to continue as we pursue our TAM in parallel with strategic paid media investments. We believe there is sizable room for aided and unaided awareness to grow long-term, and we are at the early innings of our momentum. Order Ahead is continuing to gain traction, and our investments are making accessing Dutch Bros seamless across multiple touchpoints. We're adding meaningful sophistication to our analytics engine, setting Dutch Bros apart even at this early stage. At the end of Q3, our Order Ahead mix reached 13%, with some new markets mixing at nearly double the system average. This growth highlights the natural strength of our program and the enthusiasm our customers have for Dutch Bros. To build on this momentum, we recently enhanced the user experience by introducing a more precise order pickup time feature, which has already led to improvements in order readiness and an increase in scheduled orders. The increasing Order Ahead mix has also created a powerful on-ramp for our Dutch Rewards program. This program continues to remain a key engine for driving transaction growth over the long term. In Q3, approximately 72% of system transactions were attributed to Dutch Rewards, marking a 5-point improvement year over year. With Order Ahead feeding into this ecosystem, we're now focused on unlocking the full potential of segmentation, deepening engagement, and driving transaction growth by confidently reaching the right customer at the right time. Notably, in Q3, Dutch Rewards contributed to transaction growth, with us running almost exclusively segmented offers, further underscoring the organic strength behind our loyalty platform and the ability to manage discounts strategically year over year. Even more encouraging is the momentum we're seeing from younger cohorts within Dutch Rewards, highlighting the strength and long-term potential of our loyalty program. In addition to a strong digital presence, we have a differentiated innovation platform. Since 1992, our commitment to beverage innovation has been a cornerstone of our success. We have seen success in leading the industry in beverage trends and delivering exceptional experiences across our coffee, energy, and refreshment offerings. In July, we introduced 3 exciting new beverages: Blue Lagoon with strawberry fruit, Mudslide Mocha, and Strawberry Colada, demonstrating the breadth and strength of our innovation across the entire menu. We kept the buzz going throughout the quarter with engaging brand activations, including the launch of the Fun Boy Drink Floaty, National Dog Day Bandana, and Car Coasters, all designed to deepen customer connection and drive brand love. In August, we brought back fall LTO offerings like the Caramel Pumpkin Brulee and Cookie Butter Latte, alongside the Candied Cherry Rebel, reinforcing our commitment to category-wide innovation and customer relevance. This LTO lineup was our most successful fall LTO launch to date. At Dutch Bros, innovation goes far beyond beverages. Our value proposition is about the experience, the connection, and the energy our customers feel every time they visit. We've pioneered the drive-thru innovation platform, and these limited-time offerings provide that unforgettable moment. In addition to our differentiated innovation engine and robust digital presence, we've reached an incredible and advantageous scale. Just 4 years ago, we celebrated our 500th shop opening in Texas during the year of our IPO. This year, we surpassed 1,000 shops, and we're well on our way to doubling that as part of our multi-year journey to reach 2,029 shops in 2029. Beyond shop growth, we've successfully scaled system-wide AUVs, which are at record levels, and significantly improved adjusted EBITDA, clear indicators of the durability of the Dutch Bros brand. We've also assembled a management team with experience at scale, positioning us to execute on our rapid growth ambitions with confidence. Our team brings depth, enabling us to successfully make agile strategic decisions that support our long-term vision. We are investing in advanced analytics, tools, and processes to maintain differentiated momentum as we scale, laying the foundation for disciplined, self-funded growth. In closing, the momentum in our business remains strong, and we are just getting started. We're in the early innings of a multi-year journey, and our focus strategy is clear and working. We are built around culture. It's the engine of our differentiated customer experience. Our baristas bring this culture, energy, and connection to life every single day, delivering magic at the window that continues to connect deeply with our customers. We are focused on delighting our customers and growing sales, and it's paying off. Our multi-year transaction-driving initiatives continue to resonate, marking our 5th consecutive quarter of transaction growth. We have a differentiated innovation engine and strong digital presence that isn't easily replicated. From high-velocity LTOs to the virality of our product and merch drops, we're delivering a best-in-class experience that is setting us apart and positioning us to naturally take share. We are on track to have 2,029 shops in 2029. Our AUVs are at record levels, highlighting the portability of our brand. Our long-term 4-pronged strategy is simple and powerful. Grow our people, grow our shop base, grow our transactions, and grow our margins. We are playing the long game, and we're executing. We are on the offensive, and our efforts are positioning us to win. With that, I will turn it to Josh, who will discuss our financial results.
Thanks, Christine. I'll provide a recap of our third quarter results, along with an updated outlook for 2025. Our third quarter performance built on the strong momentum from Q2 and reinforced that a differentiated model is resonating with customers. With our digital presence and our other transaction-driving initiatives still in the early stages, we remain confident in the long-term growth potential of our business. Third quarter revenue was $424 million, an increase of 25%, or $85 million over the third quarter of last year. System same-shop sales growth was 5.7%, driven by an exceptional 4.7% transaction growth. We saw strength across our transaction-driving initiatives throughout the quarter, particularly Order Ahead and Dutch Rewards, which contributed to the Q3 momentum. With Q4 off to a great start, we are raising our full-year system same-shop sales growth guidance to approximately 5%. This implies approximately 3 to 4% system same-shop sales growth in the fourth quarter, which includes the continued momentum we have seen in October, the early positive impact we are seeing from shops that have the new hot food program, a full quarter lap of Order Ahead, and the impact of cycling a strong Q4 from last year. We remain excited about the opportunity with food. Early shop results suggest that we could expect an approximate 4% comp lift in shops that have food, with about a quarter of that coming from transaction growth. We plan to continue rolling this out to shops that can support hot food throughout 2026, so we would expect that lift to be phased in throughout the year. During the quarter, we opened 38 new shops, bringing our total system shop count to 1,081 shops. In Q3, a substantial portion of our openings occurred later in the quarter, and we anticipate a similar situation in Q4. New openings below 160 in 2025 are expected to be incremental to our 2026 target of approximately 105 system shops. As Christine mentioned, our development pipeline is at record levels, and the pace at which we are adding to our pipeline provides strong visibility on our path towards 2,029 shops in 2029. In the quarter, adjusted EBITDA was $78 million, an increase of 22% or $14 million over the third quarter of last year. Switching to our company-operated shops, revenue in Q3 was $393 million, an increase of 27% or $85 million over the third quarter of last year. Company-operated same-shop sales growth was an outstanding 7.4%, with 6.8% coming from transaction growth. Company-operated shop contribution was $109 million, an increase of 20% or $18 million year over year. Company-operated shop contribution margin was 27.8%. Beverage, food, and packaging costs were 25.9% of company-operated shop revenue, which is 60 basis points unfavorable year over year, driven primarily by higher coffee costs. We continue to expect the impact of coffee costs to accelerate in Q4, and as of now anticipate that coffee costs may remain elevated into 2026. We would also expect elevated costs associated with our broader hot food rollout to begin in Q4 of 2025. Labor costs were 27.5% of company-operated shop revenue, which is 10 basis points favorable year over year, primarily driven by sales leverage and partially offset by the impact of labor investments made earlier in the year to support our long-term growth. Looking into Q4, we are anticipating the quarter to be impacted by approximately 50 basis points from regulatory changes, resulting in higher employer payroll taxes in the state of California. Occupancy and other costs were 17% of company-operated shop revenue, which is 60 basis points unfavorable year over year, driven largely from the impact of occupancy rates from new shops, as we have made great progress in shifting our portfolio to more capital-efficient build-to-suit lease arrangements. We expect this impact to continue in Q4 and into 2026 as we maintain this momentum. Pre-opening expenses were 1.8% of company-operated shop revenue, which is 60 basis points unfavorable year over year, driven by the proportion of shops in newer markets and the associated cost of sending our training teams to support these openings. Given our planned openings for Q4, we would expect pre-opening expenses on a per-shop basis to remain relatively consistent with what we experienced in Q3. Moving down the P&L, adjusted SG&A was $58 million, or 13.6% of total revenue. We continue to be thoughtful about investments we make in SG&A while driving consistent leverage as we grow the top line. Given the continued momentum here, we now expect approximately 110 basis points of leverage on adjusted SG&A for 2025. For the quarter, we delivered 19 cents of adjusted EPS, up from 16 cents or 19% from Q3 of last year. Let me now provide an update on our balance sheet, cash flow, and liquidity. As of September 30th, we have approximately $706 million in total liquidity. This liquidity includes $267 million in cash and cash equivalents and approximately $440 million in our undrawn revolver. During the quarter, our net cash position sequentially increased by approximately $14 million from Q2, driven by strong cash flow from operations. In Q3, our average CapEx per shop was $1.4 million, clearly demonstrating our ability to transition our portfolio to more capital-efficient build-to-suit lease arrangements. This gives us strong visibility and confidence into positive cash flow generation, reinforcing the scale and strength of our long-term financial model. Now let me provide an update on our 2025 guidance. In light of our strong performance throughout the third quarter and into October, we are raising our full-year guidance for total revenues and system same-shop sales growth. Total revenues are now projected to be between $1.61 and $1.615 billion. System same-shop sales growth is now expected to be approximately 5%. Adjusted EBITDA remains in the range of $285 million to $290 million. Total system shop openings in 2025 are targeted to be 160. Any new shop openings below 160 in 2025 are expected to be incremental to our 2026 target of approximately 175 shops, reflecting confidence in our shop growth trajectory. Capital expenditures remain in the range of $240 million to $260 million. We are energized by the strength of our business. Our people, our resilient financial model, and our differentiated transaction-driving initiatives place us in a category of our own. Our high-growth, multi-year trajectory is exceptionally well-positioned to deliver consistent, dependable results, supported by record-high AUVs and a superior four-wall model. Thank you, everyone. We will now take your questions. Operator, please open the lines.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two to remove yourself from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star key. Your first question comes from Christine Cho with Goldman Sachs. Please go ahead.
Thank you so much for the presentation. So I'd like to kind of understand a little bit better in terms of thank you for all the color. When comparing kind of innovation, paid advertising, order ahead and Dutch Rewards, all of these things that were catalysts to your traffic year to date, which are some of the levers you think have the highest remaining runway, and what 2026 product and platform innovations are most likely to continue as a Bros multi-year growth saga? Thank you.
Yeah, Christine, thanks so much for your question. You know, when I look across all of the different levers we have, I actually think we're in early innings in many of them. I look at innovation and how our teams are really looking at each promo period and understanding what worked exceptionally well, where the market's going, and what they can tweak to add to that. We just had our strongest fall LTO launch and brought back a number of the drinks for last year and just executed them really well. With paid advertising, I think we're continuing to do a lot of learning in which channels work best for us, where we spend versus the maturity of the market. And so again, early innings there as we continue to learn analytically just where to place those place our dollars in that paid advertising. And just as a reminder, we're really using paid advertising to grow brand awareness. It's that one ramp for the brand that we then get customers into Dutch Rewards, where 72% of our transactions are Dutch Rewards transactions. So we really have this very efficient channel to speak with them. On Dutch Rewards, we've really made the transition this year in moving from all broad-based offers to more segmented offers, but we have a lot of runway still ahead to further segment that customer base, learning what drives different customers to increase their frequency. So a lot of runway still there as well. Then looking at mobile order, again, we continue to see that nice steady march up in mobile order. And we are really learning, like operationally, as we hit some very high penetration levels, especially in newer markets, how to split our KDSs between different stations to deliver on those. And then we're at the very beginning of food, but incredibly encouraged by what we're seeing early on, the love from both our Broistas and our customers for that program. So when I look across the board, I actually think we still have a lot to go in each of our areas to drive transactions.
Thank you. We've heard some of the peers highlight consumers under 35 as kind of particularly challenged cohort in the recent months, driven by unemployment and student loan repayment, et cetera. So given kind of your exposure to this age cohort, could you kind of talk to any changes in consumer spending behavior that you're seeing amongst the younger consumers, although your numbers really seems to suggest that that's not the case for you. Thank you.
Yeah, so as you can see, we had an incredibly strong quarter with 5.7% system same shop sales growth. When we look across our younger cohorts, again, with 75% of those transactions coming from Dutch Rewards, we can segment that by age cohort, and we're seeing really incredible performance out of those younger cohorts. I think that during times like this, customers are choosing the brands that they love the most and really deciding to spend their dollars there. And what we're seeing out of Gen Z and that continued growth and that huge in that cohort is really encouraging.
Please limit to one question. Next question comes from Dennis Geiger with UBS. Please go ahead.
Great. Thank you, and congrats on the strong results, guys. Very helpful data points on the food offering. I was wondering if you could speak a little bit more to what you're seeing from a customer feedback standpoint, employees, how that's working. I'm curious, anything else on sort of attachment incrementality? I mean, you gave us the important numbers, I know. And just related to that 25% that won't get food, can you give us a breakdown of company versus license there and what that looks like? And I guess last, just on the food, if you could touch at all more on the food costs in the fourth quarter, the hot food costs that you spoke to. Thank you very much.
Thanks so much, Dennis. I'll start with customer and barista feedback. So that's something that we're carefully managing. We actually have trackers in place to manage that every single week. One of the things I'm really encouraged by is as we are rolling this out in successive markets, we're actually seeing improvements in both barista feedback and in customer feedback as we continue to roll this out. So I think we have just an incredible launch and start to the hot food program. I am incredibly impressed with how our baristas are embracing the program and rolling this out to our customers. I'll give it to Josh for some of the margin questions.
Yeah, well, and the question on the kind of the breakout between company franchise, really that limitation is related to space constraints in the size of the shop. So, we haven't given the specific breakdown of what that looks like, but you can imagine in the older shops where there are more franchise shops, that's where there would be challenges in being able to launch hot food. On the margin specific, we're in 160 shops at the end of Q3. So you can imagine just on a relative percentage basis, it is a smaller impact, but as you might expect, COGS for food is relatively higher than beverage. So would assume a slight amount of pressure coming into Q4, and then as we roll this out, that adding to it in 2026 as well.
Next question, Andy Barish with Jefferies. Please go ahead.
Good evening, guys. Could you give us a little more color just sort of on the ticket dynamic or check dynamic? Obviously, you're seeing a negative mix, with pricing, I think around 2% or so. What's going on there? And then, as you look out to 26, I'm assuming, food could be a part of, getting that going back in the right direction.
Yeah, Andy, thanks for the question. As you pointed out, yeah, we're sitting on about 2 points of price, and that's being offset by about a point of mix. That has been fairly persistent, consistent throughout the year. So we've seen a bit of offset coming from mix, largely driven by lower items per transaction, certainly contributing to that as we've launched Order Ahead, that is targeting more of an individual type occasion. So that would be an element of it as well. Certainly not providing guidance on 2026 comp yet, but what I would share is, we're sitting on about 2 points of price. We'd roll off of half of that in January and the other half in July. Going to be, very thoughtful about how we think about our overall value prop for the year, but feel really good about how we're positioning ourselves heading into next year.
And I would just add with that 4% comp lift that we're seeing in food, about a quarter of that's coming from transaction growth, which we're really excited about. We thought we might be missing a beverage occasion there, so starting to see that, and then 3/4 of that coming from ticket and attach.
Next question, Andrew Charles with TD Cowen. Please go.
thank you. Your success is inviting competition with the largest restaurant in the world piloting a new line of energy and iced coffee beverages in Colorado at the start of September. Can you help articulate what you observed in the last 2 months of sales in that market since that pilot launched?
Yeah, thanks so much for your question, Andrew. So as we actually look across all of our markets and have been paying particular attention to shops in that market, we have not seen any impact on our shops. We continue to have a great quarter and into a great October, and so really excited by what we're seeing overall, but did not see an impact from that test.
Next question, Sarah Senatore with Bank of America. Please go ahead.
Thank you. Hopefully I can get in a question and a half. The half is just clarification on, Christine, your comment about younger consumers kind of choosing the brands that resonate with them. I guess, do you have a sense of, coffee, if you're sort of really taking share in the coffee segment, or if, coffee broadly is doing better? I guess just trying to, put that in the context of this perception that maybe coffee would be more cyclical or more, easily kind of given up, but it sounds like actually there's a lot of strength, and I wasn't sure if that was the segment or Bros particular or both. And the question was about seeing improved transactions during peak hours. Are there any metrics you can share about throughput? I don't know if it's the number of transactions or number of beverages, just sort of where you are now and what you think a target might be, as I think about how throughput might contribute to transaction growth. Thank you.
Yeah, so on your first question on the strength of the market, so we do believe it is a strong market overall. We also believe we're performing exceptionally well within that market and able to compete in a way that is likely driving some share gains. I think that we are just super well positioned when you take beverage overall. Both coffee and energy are growing. Energy seems to be growing faster, and we are the category creator really of customized energy, so very well positioned in that high growth space. We're also seeing higher iced, higher customization, customers that want that quick interaction, but for it to be quite memorable. So we just believe we're incredibly well positioned across the market. And then from throughput metrics, we haven't shared those, but that is something that we track. So we are tracking transactions at peak. We're tracking things like window time, other things like that. And then we're also very closely looking at how our labor is deployed to really match those demand curves. And all of those things, our teams are just doing a great job to make sure that our customers are having an incredible experience.
Next question, David Tarantino with Baird. Please go ahead.
Hi, good afternoon. Congrats on great results here. Josh, I was wondering if you could comment on why the EBITDA guidance range didn't the increase in the sales guidance range. I'm just wondering what some of the cost offsets were that you didn't contemplate previously.
Yeah, great question, David. So, we've been really thrilled with the overall performance of the business and the strength of our four-wall model. It supported us the ability to make some investments. In particular, if you look at our pre-opening costs, we are continuing just to see incredible openings as we go into these new markets. We continue to be met with really long lines. So we're sending our training teams out in support of those openings just to really set our teams up for success. So, as we commented, we saw elevated pre-opening costs in Q3, and we'd anticipate seeing on a per shop basis pre-opening costs being consistent in Q4 with what we saw in Q3. Certainly with greater number of openings in Q4, that's higher absolute dollar basis as well. The other side of that is we've continued to see accelerated coffee costs coming into the P&L. Just that will accelerate into Q4. Certainly previously contemplated, but it is one that will continue to accelerate into Q4. And then the third piece that is impacting is the higher taxes that I referenced in the state of California, putting about 50 basis points of margin pressure in the labor line. That's really a kind of a full year amount that we're expecting impact the individual quarter.
Next question, Brian Harder with Morgan Stanley. Please go ahead.
Thanks. Good afternoon, guys. When you talk about the lift from food, is that basically is it like the original cohort of stores that had it measured after 6 or 12 months? Could you just talk about how you arrived at that? And then, you know, do you think that you can sort of augment that over time? Like, obviously, once you have it more broadly rolled out, maybe awareness goes up, you could advertise it. Like, how do you think about, you know, continuing to drive food over time?
Yeah, so as we look at the lift from food and how we're measuring that, we're measuring it kind of pre-post versus control. We're looking at, you know, absolute transaction growth. We're looking at overall same shop sales growth in those markets, and have had the food program in some shops for a longer period of time now. So giving us confidence to share the numbers at that point. And then I think the way to think about food is it's really a program that we're just getting started with. We've had traditionally about 4 SKUs within our shops, the 3 muffin tops and the granola bar. This initial food rollout is just moving us to 8 SKUs, so just adding 4 SKUs there. But what it is it's providing a capability where we now have ovens. We're putting in the inventory management required to have that food program. So I think of it as really serving as a base for what this could be over time, and think that it has huge potential as we go forward.
Next question, Sharon Zackfia with William Blair. Please proceed.
Hi, thanks for taking the question. You know, I'm curious, as you've been expanding into the Southeast and now into the Midwest, by the way, welcome to Greater Chicago. Are you seeing kind of a similar customer demographic and anything that surprises you in the way the customers are using Dutch or the day parts or the product mix? Just wondering what you're learning as you're growing further nationally.
I think we're seeing some of the same things that we've seen. In that we do have a higher coffee mix as we first go into newer markets. We are seeing that higher mobile order mix as well as we go into new markets. Those things have been pretty consistent. I do think as we really reach this more national scale, as we pass that 1,000 shop mark, the brand kind of precedes itself. And so when we show up in these markets, we're just met with incredible excitement, initial demand. They already know that our sticker days are coming and are lining up for the sticker days. So I do think as we reach higher scale, we are seeing the benefits from that as we go into new markets. I think we've also done a lot of learning in what is the best way to go into a new market, make sure the team's set up for success, and what are our phases of marketing as we go through those new markets. And, you know, as we've shared, we're incredibly excited by that new shop productivity that we continue to see.
Next question, John Ivanko with JP Morgan. Please go ahead.
Hi, thank you. I was hoping to drill in a little bit in terms of what's going on in some specific markets. And, you know, obviously, you know, you're located next or at least near, you know, some specialty coffee outlets that have been closing stores. And yet in other markets, you know, there's a number of specialty coffee outlets that have been significantly opening stores. So I wanted to see if there's any interesting dynamics we can talk about on a market level basis that maybe are influencing, in positive or negatively, you know, your access to real estate, people, and customers. Anything that we can maybe, you know, talk about that's a little bit below the surface. Thank you.
Yeah, so I think as we continue to open shops, like the one dynamic that you'll see is more of our new shops and those newer vintages are in the company operated side in the business. So I think as you probably saw, we had 7.4% same shop sales within company owned, driven by very strong traffic at almost 7% there, 6.8%. And you know, as we continue to look for new shops and new markets, I think the strength of the brand, the longevity that we have been out there as a landlord. We have incredibly attractive cap rates now, you know, as we continue to grow across the country. We're really not seeing any shortage in sites. And as I shared in my prepared remarks, we've actually added about 30 sites per month over the last 6 months into our pipeline. So seeing great availability of great sites. And I think it's also due to, as we're ingesting data more quickly into our models and seeing the performance that we're seeing now we're really able to better pinpoint how we're going to do in a market. So, have both confidence in what that will look like when it opens, but also we are finding great sites as we move across the country.
Next question, Gregory Frankfurt with Guggenheim Partners. Please proceed.
Hey, I just wanted to follow up on that, Christine. 30 sites a month. I mean, that's a ton of stores. Is that normal that, that would only translate if you open, 300 sites approved or 350 sites approved, that would only translate into 150 to 200 openings, or is this an indication that 27 and 28 you're gonna really ramp the store growth? And can you maybe just talk about the availability of real estate and what you're seeing out there from a competitive perspective? Just a follow-up to John. Thanks.
Yeah, so thanks, Greg. As we look ahead, we're really confident in that 2,029 shops in 2029, and part of that is building that really strong pipeline right now. So as we look ahead, a lot of the shops that we're adding now are really going to open 2 years from now, and so that gives us just great visibility into getting to that ramp where we'll be opening those shops. Not all of them will translate, but the majority of them certainly do translate into actual sites as we've looked at history. So we are ramping up that pipeline to prepare for that higher growth as we move ahead.
Next question, Jeff Farmer with Gordon Haskett. Please go ahead.
Thank you. You did touch on it, but any color you can offer on the scale of your paid advertising efforts in the Q3, Q4, just the back half of this year, relative to, let's say, a year ago? And then as we look forward, do you expect that scale to further build?
Yeah, so as we look at paid advertising, we really look to continue to ramp that as we ramp our sales and for that to keep pace. We've been very happy with the results that we're seeing and really view that as paired along with our Dutch Rewards program. So, 72% of our transactions are coming through Dutch Rewards at the shop level. And as we look at that, it's really important to use paid advertising to build the brand awareness and then to quickly get our customers into the Dutch Rewards program so that we can speak to them that way.
Next question, Jeffrey Bernstein with Barclays. Please go ahead.
Great. Thank you. Just a question on the mobile order and pay. I think you said it's now at 13% mix, so creeping higher, but I don't believe that's with any material internal push on your part. And I think you mentioned some of those markets are actually double that, so maybe a quarter of their sales or traffic from a mobile order. So I'm just wondering, there are clearly peers in the beverage segment well above that. I'm just wondering if you could talk about what you'd like to see with that in terms of the acceleration, maybe quantify any kind of benefits you see in terms of traffic or check or frequency, anything, incremental learnings as we think about the next couple of years and where that 13% goes. Thank you.
Yeah, so as we look at that 13% mix, we're very happy with where that is. I think we've shared in the past that this is something that's customer driven. It was the number one thing that our customers were asking for from functionality from our app. And we want our customers to be able to order in the channel and in the way that they'd like to order. I think naturally over time, given what we're seeing with new shops, is that percentage will increase as I think we're seeing very close to like market level volumes in mobile order in those new shops. And, I think customers actually really act in a way that makes a ton of sense. So in our smaller shops or our original double drive-throughs, it just doesn't add as much speed to your day as it does in the new shops that we're rolling out. So I would expect to have some bifurcation in the newer and legacy markets over time, but incredibly encouraged by what we're seeing. It continues to grow. We also like the interplay that we're seeing between mobile order and food and how easy it is to attach items once you're mobile ordering. So seeing a lot of good things there.
Logan Reich with RBC Capital Markets. Please go ahead.
Hey, good afternoon. For taking the question and congrats on the solid results. My question was on the food rollout, more on the operational side. I'll try to fit it into one question. But can you just give any additional color on what the changes in the operations are in the back of house for the stores that have food? Like, just curious if you need to add any additional labor to fulfill food, or any differences you're noticing on throughput with the stores with food versus those without. And then just separately on your last comment related to mobile order pay, like, do you view food as a driver of mobile order pay, or vice versa? I'm just trying to get an understanding of the interplay between those two aspects of your business. Thanks.
Yeah, so from an operations standpoint with food, we are adding new equipment into the shop. We're adding new training, obviously, as we roll that out. And then some of the operational metrics we're looking at is one, as we built out the food platform and the offering that we have, the oven cycle time for the food items is below the average drink make time. And so that was very intentional. We never want to slow down our line as we add in food. And as we've rolled this out to new shops, we're continuing to see throughput gains in those AM day parts in the shops that we've rolled out food. So we really are seeing that work seamlessly. And then from a labor perspective, we are investing in labor and food as those sales grow. So overall, I think that food has slightly higher COGS, but a lot of the other line items really, as you scale, work quite well with food, and it can really leverage some of those other places. As we are seeing those volume gains, we are investing against the volume gains themselves. And then for mobile order and how that's interplaying, I just think that the app is such an easy way to discover, to discover new offerings that we have. And so I think part of that is interplaying with it. I also think that there's a high mix between a customer in the morning who wants mobile order, who might also want a food item. And so I think we're seeing some of that natural mix together as well.
Nick Setyan with Mizuho, please go ahead.
Thanks for taking the question, and congrats on a great quarter. Just a clarification question. The clarification, the 50 basis labor headwind, that's just in Q4, or is that something that's going to continue into 2026? And the question is just an update on the CPG rollout in 2026. How are we supposed to think about modeling it? Is it just pure licensing, flow through, any numbers around it, or just bracket in terms of how we should think about the CPG rollout next year would be very helpful. Thank you.
Yeah, Nick, thanks for the question. Yeah, the labor impact is a full year impact that we would anticipate in Q4 as a result of some regulatory changes. So that would come into effect in Q4. The ongoing run rate obviously would be something less than that. The amount is a full year amount in a quarter. I'll let Christine talk to the CPG piece.
And then on the CPG rollout, so we are really in the midst of sell-in right now to retailers. We are also finalizing all the products and doing all the final tastings as we get ready to launch this. We are really encouraged by the enthusiasm that we're seeing from retailers for the CPG lineup. That is something that will roll out throughout 2026. So as retailers do their resets throughout the year, you'll start to see the Dutch Bros product come in. We've also shared that we're really going to have the CPG offering follow our shops. And so it will be a regional rollout based on where we have stops so that customers can really experience Dutch Bros at the shop first and then go experience at home.
Chris O'Cull with Stifel, please go ahead.
Yeah, good afternoon and congrats on another great quarter. Christine, I appreciate the comments you made earlier about the people first culture and the Broista engagement as being the concept's primary competitive moat. But as you scale to, let's say, 2,000 or more shops, it would be harder to sustain this culture. And I'm just wondering, beyond promoting from within, what specific or measurable mechanisms do you have in place to ensure the quality and consistency of the Broista experience isn't diluted? For instance, how do you systematically identify and correct any kind of cultural drift as you expand?
Yeah, thanks so much for your question. So if we look ahead, I think we are in a really unique position with being able to open all of our new shops in all of our new markets with with operators that have been with the brand for quite some time, on average 7.5 years. And I think at 1,000 shops, that's what's really served us incredibly well, is having culture carriers who have been looking forward to that opportunity to go open a new market. We do have measurement mechanisms in place. We do surveys. We do things like that. I think that those are important metrics to have, but we also have great listening systems. And I think that's the most important piece, is making sure that as we roll anything out, we are listening very deeply to how our teams are feeling about different things, to make sure that we're enhancing the experience. As we roll out food, for example, we're doing a food benefit for our baristas, and so that they can taste and share in that great food as they come on to their shifts. And so I think we're being incredibly thoughtful about ensuring that our shops are staffed well, that we're listening to what's driving satisfaction at the broista level, and just continuing to enhance that experience the same way we're looking at our customer experience.
Thank you. I would like to turn the floor over to management for closing remarks.
Yeah, thanks for your questions. In September, we proudly hosted our annual Buck for Kids Day, with the Dutch Bros Foundation supporting over 245 local nonprofit organizations focused on programs serving youth in our communities. Giving back to the communities we serve is core to who we are. Our local operators and franchisees selected each of these nonprofit partners, ensuring the impact was felt directly in the neighborhoods we serve. Also in September, from all around the country to join us at our headquarters for a leadership development program. It was an incredible opportunity to share stories, learn from each other, and continue building the strong foundation that fuels our growth. Investing in our people and giving back to our communities is core to who we are, and our mission remains unchanged. Whether we are slinging drinks or serving up love, Dutch Bros has always been and will always be about the people. It's this deep connection with our communities that continues to fuel our purpose and drive our growth. Thank you to all our team members for bringing our mission to life. You are the reason our customers continue to show up every single day. I am incredibly grateful for all of you. Thank you.
This concludes today's teleconference. You may disconnect your line at this time, and thank you for your participation.
All right. I thought it was a very bullish call. I'm cautiously optimistic around the food. Of course, they did talk about the cost of goods being higher. And so I think that really is going to be, I don't want to say a loss leading item, because I don't think they're going to lose money on the food. But I think what they're trying to do is really sell an additional beverage per day. So I think what they're just trying to do is just get unit volume up throughout the entirety of the day for beverages. And if that is by chance through the food, then I think that that's what they're trying to sacrifice. The thing that I'm also kind of curious about, and of course, they talk about robots for quick orders. It's against the culture of the company, so I don't think that they'll do that unless the AI could be super, I guess, friendly and things like. If you've never been to a Dutch Bros, maybe you just don't understand. But the whole piece around it is that experience to be able to actually have a good customer service experience and not go to a Starbucks where you generally don't get a good customer service experience or something like that. So that's part of the reason why, I think Dutch Bros has done well is due to that actually being a pleasant experience of going and getting a drink versus, feeling like who knows if somebody just spit in it because they're angry and hate their life. Um, so I think that that'll be far from what happens in the near future. Now, of course, 10 years down the road, as things change, right? And they could always do that. But for right now, I don't think that that's even in the cards. But they did say something that was very bullish that I was kind of concerned about the food aspect of things. And they said that generally on normalized basis, the food takes less time to prepare than a drink does. So if anything, the drink is likely to be holding up the order than the actual food would be. So what did give me pause though was they talked about having ovens in each store. I don't necessarily know if those ovens are going to be just like keeping things warm, and the food is going to be kind of created in the beginning of the day or during slowdowns or what have you. But the last thing I want is people to be making things from scratch. So I'm cautiously optimistic. I think it's going to obviously drive things in the right direction. But like I said, cautious because having to stop and make some peanut bread, not peanut bread, whatever the loaf that they're going to be providing, or the chorizo melts or something like that. It's going to hold up transactions overall. So. But apologies, guys. It is getting late here. It's 11 p.m. and unfortunately, I'm like running between two different time zones. And so I appreciate you guys sticking with me and listening to the call. I'm cautiously optimistic. Going to continue to buy. And I appreciate that question about the robots. By the way, I just hope that people understand, like, there's certain things that companies will do to help drive efficiency, but particularly around culture, as you can hear, is probably the primary thing or one of the primary things for Dutch Bros. But anyway, yeah, I'm cautiously optimistic the company will continue well. I'm continuing to buy every paycheck. I wasn't for a long time until it started to get to the 50s again. So I think it's for me something that I'm looking forward to adding a few shares here and there, and wouldn't mind doubling up my position here in the 50s. I think eventually this company will be worth 25 to 30 billion dollars, and eventually I think they're going to be doing share buybacks, potentially dividends. So if that means that this turns into a couple $100,000 position, I'm able to write covered calls and get a little bit of extra income from that, then that's what it's all for. And that's the hope that I have for keeping this in the portfolio. And who knows, depending on what happens with food, maybe it ends up being something a lot larger than 25 to 30 billion. But the reason why it's different than some other companies is it's not a franchise. So you'll see that they have some franchises, but they're no longer doing franchisings. So I think the old franchisees, due to the contract, can still up uh, do more franchises, but they're not adding any additional franchisees. Like I can't apply to be a franchisee, right? And they're not going to give me a store. But somebody who's previously in the system as a franchisee can grow stores still. And so I think that that's when you're seeing the franchise stores continue to grow. I think that's the occurrence. Um, but the majority of the stores are company owned, so they're able to get that 25 to 30% contribution margin direct to the bottom line. And so everything's looking pretty peachy keen. So, but I'm curious to see how, with the increase in total ticket sales, margins get hit because obviously, if you're selling food, cost of goods sales are going to go up. So you're going to sacrifice potentially that beautiful contribution margin to be able to get more people through the door, but at the same time, maybe it's going to be fully offset by the fact that you get more transaction volume, and really the big cost of the contribution is the SG&A per store. So I don't know, I'm not 100%, but really hope this helps, and really looking forward to seeing as things continue to roll out in 2026. Um, no, they don't. They no longer do franchising. I'm like 85% certain on that. Um, So, what was I going to say? You think you need to be at a store for 3 years before you can become a manager or open up and be a general manager of company stores. But franchising, I think is different. Um, okay, you want to go there? Let's see, Grok. I would be gladly proven wrong if that's the case. Let's see. Let's see. Franchising for Dutch Bros stores. Yeah. How do I hide this? There we go. Franchising for Dutch Bros stores. Dutch Bros, a popular drive-through coffee chain founded in 1992, has a unique history of franchising. While initially expanded through franchises during the late 1990s, the company shifted away from this model over time to prioritize company-owned growth and internal development. As of November 2025, Dutch Bros no longer offers franchising opportunities to external applicants. All new locations are company operated. Any operator roles similar to franchise ownership are reserved exclusively for high-performing internal employees who align with the brand's culture. Company and operator roles. Yes, operator roles, but not necessarily franchise ownership. Maybe it is. I don't know. Hold on. Maybe you're right. Can internal employees franchise, or are they just store operators? Internal employees cannot franchise in the traditional sense, i.e., buy a franchise agreement. Whoa, why did that happen? Buy a franchise agreement, pay a franchise fee, and own or operate a store under the Dutch Bros as an independent business owner. Instead, high-performing internal employees can operate as an operator, sometimes called regional operator or multi-unit operator roles, which are company-employed leadership positions, not franchises. Here are the distinctions. Eat shit, bitch. Just kidding. So yeah, sometimes words matter, and clarity on those particular things matter. So yes, no longer franchising. It's strictly for, I believe, old franchisees that are in the system. So yeah, I think that's been part of the reason why their stock has performed so well, because they're able to get that 30% contribution margin direct to the bottom line. So sorry, I just wanted to be playful there, but yeah, pretty certain I know what I'm talking about with some of these things sometimes. So appreciate everybody hanging out, and I am going to shower and get ready for the day tomorrow, and hopefully you guys have a nice evening if you're in the US, and appreciate you listening in on the call. So talk to you guys soon. Cheers. Have a good night.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Look at this thing. It's beautiful!
Welcome to the fucking show.